Why is tax planning important? So as long as you pay taxes in the US, you might have some income, right? It could be your earned income, it could be your business dividend, or it could be your capital gains. And out of that 100% of income, maybe some of it will go into your expenses, like living expenses and paying for childcare, paying for supporting your family, donating to charitable organizations, etc. And what's left is debt, servicing debt like student debt, mortgage, or sometimes car loan or personal line of credit, or you can invest. Since we're all here, I believe financial freedom and financial security is a goal for a lot of people. So this is incredibly important if you want to achieve financial freedom and financial security. Essentially, like expenses would be gone after you spend it, right? But investment is the part where it might have a potential to grow and then support your future goals. You might be asking, like, why is there such a big part missing? And that's because we pay a lot in taxes. Well, compared to a lot of developed countries, US has comparably low tax burden. However, there's still a lot, right? Start with 7.6% in payroll taxes. That is deducted from your paycheck if you are an employee. So after that, there's anywhere between 10 to 37% in federal income taxes. So your employer also withhold that tax for you on your behalf, but sometimes it's not enough, and we'll talk about that. And then there's state and local taxes. For most states, they either use a progressive tax system, where the more you make, the higher your tax bracket. And some states use a fixed rate. So Arizona, where I am, it used to be a progressive tax rate anywhere between 2 to 4.9%. And this year, it changed into a flat tax system, where it's 2.5% flat. And actually, a lot more states are now going into the flat system because in general, people see the population is going from higher progressive tax states, such as California and New York, and going into lower tax rate states. So that's why there is a trend of states changing their tax system into lower flat rate. And then for the higher income people, that's typically if you are filing single, then more than 200,000 per year in income. Or if you are filing as a couple, it's 250,000 as a couple, no matter where you are. If you make more than that, then there's a 3.8% net investment income on any kind of dividend or capital gains or passive rental income. And also, there's a 0.9% of Medicare tax that's in addition to this 1.45% on any of your earned income. So a lot of my clients, they are already in a high tax bracket. When we talk about high tax bracket, normally the rule of thumb is if your federal and state marginal tax crosses over 25%, then we would consider you're in a high tax bracket. Or if you are in a very low tax state or tax-free or income tax-free state like Florida, Texas, or Washington State, then it's probably 250,000 where those net investment income and Medicare surcharge takes place. So what can we do about it? And that's where tax planning comes in. There are so many ways, hundreds of ways in the US that's available legally to everybody to reduce your taxes. If you do your tax planning, it would effectively reduce your tax burden so that if you keep your expenses the same, the additional amount could be put into servicing your debt or invest for the future so that you can achieve your financial security and financial freedom much faster. So the first and foremost way that's available to most people, almost everybody, is tax-advantaged accounts. here is an example of how the pre-tax account can help you reduce your taxes. Here, Mr. and Mrs. Aspire, that is a case that I use for a lot of my illustrations. They have a gross income of 135,000 combined. Okay, and you can see that if they contribute nothing to 401k and HSA is a healthcare spending account, and healthcare savings account, and it's also pre-tax contribution. And if they contribute nothing after standard deduction, their taxable income is $107,300, right? And then for a federal tax calculation, you have a tiered system. That's a progressive system, starting with 10% and gradually to 22%. So their federal marginal tax is 22%. And if they live in a state, they would have a state income tax. So basically, if they're in Arizona, it would be 2.5. They would be at 24.5% combined federal and state taxes. If they are in California, in their income level, it's around 6. So total, they would be 2% plus 22%, 28%. So they would be in a high tax bracket, even though we all know in California, it's not enough for most people to have a comfortable life, especially in the Bay Area, because of the high housing price. So if you do the calculation, the federal tax total due for them is $14,221, and their effective tax rate is around 10.5%. Whereas if they are maxing out their 401k contribution and HSA contribution, so 401k is $22,500 per person, and as a couple, they can contribute $45,000. HSA was $7,750,000 in 2023. By the way, those numbers would increase every year by IRS in alignment with inflation, as well as the standard deduction. So for them, after taking this pre-tax contribution, they and the standard deduction, their taxable income would be reduced by this amount to $54,550. And then the calculation would be their marginal tax would decrease from 22% to 10%. Now they're in a much lower tax bracket, and they would save $8,000 and some in tax alone for year of 2023. So the takeaway is contribution to your 401k and HSA account would decrease your current year tax burden.